Outlook Business Investment Summit 2021 is brought to you by ICICIdirect.com. Welcome to Outlook Business Investment Summit 2021. Our next session is with Manoj Menon, Head Institutional Equities Research at ICICI Securities. Manoj has over 2 decades of experience, including 13 years in the sell-side equity research in leading domestic and foreign brokerages. Manoj is rated as #1 analyst in both consumer staples and consumer discretionary sectors in Institutional Investor Survey India. Manoj joined ICICI Securities from Deutsche Equities, wherein he was the lead analyst for consumer staples and discretionary sectors. Prior to that, he worked with Kotak Institutional Equities and Hindustan Lever. Thank you so much, Manoj, for joining me today. Please present your investment case, and then we could do a little Q&A.
Thank you, Mahalakshmi. It's a privilege, to be there in this platform today. So when the brief was given to me about, which is the best stock, in your coverage universe, in ISEC's coverage universe, obviously there are a lot of contenders for that. But when I thought about, the thought process over the last decade in terms of one company, which had actually delivered based on the India promise. The reason I say this upfront is because, most sectors in India are actually seen as growth sectors, right? Whether it is information technology or banking or consumption, infrastructure. So I don't think there is any lack of opportunity for growth in India. But what has really differentiated let's say the men versus boys, if I can use that phraseology, it's actually the execution. It's really not just a strategy. So there is one company, which is Jubilant FoodWorks, which we have selected for the discussion today, which is the master franchisee of Domino's India in the past. But at the same time, if you look at the company today, they are, in the transformation journey. We'll come to that. So it is Jubilant FoodWorks. Now, just a bit of a background about the company for the uninitiated, if any. This company belongs to the Jubilant Bharatiya Group, which is a well-diversified group, from the northern part of India, Delhi. And the journey of Jubilant FoodWorks started in the mid-90s, when the India middle class story sort of emerged. There are a lot of consumption-oriented opportunities opened up. This was one of them. Now, Domino's, as many of you would know, is one of the leading, quick service restaurants or QSRs, as we call it, globally. And Jubilant FoodWorks has got the master franchise, for this brand for India and some of the neighboring countries, Sri Lanka, Bangladesh, etc. But it's predominantly, it is just an India story. Now, as we look at the company today, they have about 1,300 plus outlets, in about 285 cities. The reason these numbers are important is for one simple factor that, I can't think of a single other restaurant brand in India which are actually, in 4 digits numbers. There's not even a single one, right? Whether it's a McDonald's or a KFC, or a Subway, there's none of them is actually more than 1,000. The Starbucks, for example, to put a reference point, is around 250 currently. A Cafe Coffee Day at one point in time used to be 1,500, but the number is possibly far lower today. So that's one. So there is an India opportunity. There is a promise. They have actually delivered on the expansion. In our estimates, the opportunity for Domino's in India is at least 3,000 outlets as of today. And you would realize that as India urbanizes, as more opportunities, more highways gets built, more opportunities for consumption, happens for the next 5 and 10 years. The number of 3,000 as of today will expand into, a much, much higher number. Point number one, there is an inherent organic growth opportunity for the brand in India. So that's point number one. The second about the Jubilant, which we like, this is more from an analyst lens when we look at it. While, as I said, every company has got an opportunity, every brand has got an opportunity. One of the important facets about Domino's is that the ROICs, or as you call it, the return on invested capital, or the payback ratios, for this particular business is actually one of the best, in the QSR space. So if you compare Jubilant's, let's say the store level return metrics with, let's say, Burger King or a McDonald's, so none of them would actually be, comfortably above cost of capital currently. Of course, different brands are in different stages of evolution. One of the key things about Domino's is actually the lower or the lowest capex per store at around 15 million Indian rupees versus most of the brands would be 25 million plus. So essentially, your lower investment requirements in the store gives you much better returns. So it is one of the classic case of good growth with good EVA positive return ratios aspect. So that's the second. The third aspect in this company that, right from the beginning, which is in the mid 90s, the company actually has been run professionally. And I believe that this is an extremely important differentiating factor when it actually comes to, typically businesses like hotels, restaurants, etc., which are not necessarily very professionally run in the ecosystem. So that's a third point. The fourth aspect is that as we speak, Jubilant FoodWorks is in a diversification mode. So while Domino's has got a very long runway of organic growth opportunity, they have recently acquired a small stake, called DP Eurasia, which is actually a London-listed company, essentially giving some exposure to Turkey and Russia, which is arguable, but whether it's good or bad, are we adding currency risk? Obviously, for every story, there are two sides to it. I look at this as a low-hanging turnaround opportunity for Jubilant FoodWorks. Then they also have the Ekdum brand, which is the biryani venture, which they have just about started and about a year back, which has got significant ramp-up potential. They also have Dunkin' Donuts, which was actually a failure or a mistake. But at the same time, it does appear that at this point, it is turning around. So there are a lot of other optionalities what the company is currently adding. So that's the critical aspect to consider when we think from a capital allocation point of view. Lastly speaking, beyond what Domino's has been doing on their own in India in terms of their growth story, we believe that the expansion of the in-home consumption opportunity driven by the food aggregators, or you call it the food delivery players, which is largely Zomato and Swiggy, who collectively employ at an industry level possibly 400,000 people as we speak. Just to put the number into context, Domino's will have approximately 30,000 feet on street. So the market expansion opportunity which is there given by Swiggy and Zomato would help Domino's to grow faster. Essentially, it's a penetration story as well. So that's our thesis on Jubilant. So it's a stock which I'm very happy or proud that when I was the IPO analyst 10 years back, I still cover the company. It's been a topic for a very long period of time. It's one of those companies which I've seen from a small cap to a mid cap, now to a large cap, and hope possibly it is headed to be a much larger cap over the next 5 and 10 years.
Sure, sounds good, Manoj. A few questions that occur to me. One is, from the time, since you are saying that you started covering this company right from the IPO time, how has the character of this company in terms of return profile really changed from then to now, and how do you see it change going forward? If you can also state what is the composition of revenues right now in terms of how much is driven by India and how much is driven by overseas acquisitions that have happened now? And secondly, how much of this is tied down to the real world or the physical world, and how much of their sales is really driven by takeaways and deliveries and so on?
So as we speak, Mahalakshmi, it is still very much an India story. It is, I wouldn't say 100% because, as I said, they have operations in Bangladesh and Sri Lanka as part of the master franchise, agreement with Domino's US or DTZ. But yeah, it's about more than 95% is India. So if you want to consider this as a subcontinent, so it is not really. So the other part of it that DP has happened 3 months back. So it is yet to kind of consummate. So that consolidation is yet to happen.
Sorry, can you just repeat that? The other part?
It just happened 3 months back. So it is something which is in the future. So as we speak, it is still very much an India subcontinent story, including Sri Lanka and Bangladesh, which is, small single digits in terms of contribution. It is very much an India story.
And what is the nature of revenue composition? How much of it is through their own channel and how much is delivery?
Yeah. Okay, so I think before I give a number, it's important to look at how it was just before COVID. So just prior to COVID, when it was mostly a steady state, if I can call it, it was actually 60-40, 60 delivery and 40 the rest of it. The rest of it essentially means that pre-COVID, takeaways practically as a habit in India just didn't exist, right? I mean, how many times as consumers we would have actually, we would have done that. So it was probably 5%. Company doesn't really break these details with that level of granularity. So our sense was, prior to COVID, 60 delivery, possibly 5 takeaway and 35 dine-ins. Currently, obviously, because dine-in is 60, 65 and 35. 60, 5 and 35. So 60 delivery, 5 takeaway, 35 dine-in was the pre-COVID equilibrium. Currently, Obviously, because your dine-in is shut, or it's just not there, or it's not steady state in the last 12 months. Obviously, 80-90%, almost practically everything is. I can't say everything, but yeah, a very high proportion is delivery plus takeaways currently.
Sure. And how do you see this? How much revenue loss has occurred because of the lockdown, and how do you see that panning out over the next year?
I think this should be an interesting year actually. So what we have seen in the last, let's say 6-9 months is that actually there is no revenue loss as such. That because what has really happened is particularly for brands which are strong in home consumption, and also there is another angle here that let's say there are certain products which are meant for or rather which are customized actually for in-home consumption. Right. Take the case of, let's say, for example, a French fries, right? While you actually have to consume a French fries within about a minute or two of production.
Right.
Whereas a pizza actually is something which can travel. Obviously because and also there is an angle that over a period of time, brands like Domino's have perfected the art of heat retained transportation, etc. Right. I mean, so the point what I'm saying is these brands and these formats are something which has got a benefit or a tailwind from what is unfortunately happening as of now. So in that sense, I realistically don't think there will be any material losses for Domino's. In fact, it could well actually gain and grow is the expectation currently.
So going for, I mean, how does that change their business model in terms of on ground assets and the expense profile for the company in terms of fixed assets and so on?
So if you're asking what are those changes which has happened because of COVID, I think three things. Last year, one of the
Essentially,
things
just assume that going forward, a lot of revenue is going to be driven through deliveries because and that is going to positively impact them. I'm just trying to understand overall how is the return profile going to be altered because of this change.
So okay, so just look at the cost line items. What would have changed after 12 months. One of the important things which Domino's did was they have actually variabilized the employee cost. But just to give you an example, after cost of goods sold, the single largest cost line item for the company is employee cost at around 20%. Cost of goods sold, which is all the material what they use, which is wheat, chicken, vegetables, cheese, etc. That's around 25%. The single largest cost line item, as I said, is employee cost around 20%. It ranges from 18 to 22 depending on which period you're talking. Broadly, you can say it's 20%. And a quite substantial component of this 20% is actually your delivery employee cost. So what this company has done in June last year was actually to variabilize it, right? I mean, so it's not a fixed cost anymore, actually. So there has been that conversion, which in our view should help the company going into the future. Second, like most retailers, I don't think it is unique to Domino's alone. I believe that a Westlife also would have done it. A Titan would have done it. Almost every company, in the retail business, would have actually done it. They have renegotiated rentals in many cases. Some of it is sustainable into the medium term. Some of it is, temporary in nature. Point number three, particularly Domino's, what I've observed is that they have actually shut down about 100 stores or rather relocated about 100 stores. So some of those locations which were high dining intensity has been now converted into those relatively lower cost locations, etc., where you could actually deliver from there. I think those are the three items. Now, looking forward, as long as your revenue trajectory does not surprise negatively, as long as basically you get your revenue growth, I think the operating leverage of whatever the actions they have done should actually result in higher ROCs, for a like-for-like revenue versus, let's say, in FY19.
And is it the existing channel that is being utilized to create these additional revenue profiles? How is that working in terms of, for example, in McDonald's, in Westlife, if you see, essentially they created 2 additional revenue profiles by way of, introducing cafe and introducing deliveries. So that's like good utilization of asset, and suddenly you can see that the complexion of the company can change even with existing infrastructure and fixed costs. So in this case, do you see that kind of change in business model happening?
Okay, so two parts to, or rather, I would address your question in two parts. The first, what has happened in Domino's is what we discussed till now. Everything else what the company is doing, which is the Ekdam Biryani part of it, or the Hong's Kitchen, which is the Chinese, cuisine venture, or even the anything new what they're likely to do. For example, their Jubilant has recently got the franchise rights for India for the Popeye brand. Maybe my pronunciation may not be appropriate, so it's Popeye.
Right.
Popeye is US, which actually belongs to Restaurant Brands International Global. And one of their leading brands, which all of us know in India, is Burger King. So same entity owns both the brands. So the India part of Popeye as well. Now, most all of these, the way I look at it, or rather the way the company looks at these businesses in our understanding, is as SBU concept, right? These are all completely different SBUs actually. There will be, of course, some back-end benefits because you'll actually have probably a similar supply chain or similar accounts or similar marketing teams. There will be some back-end, benefits out there. But at the same time, these are all incremental investments, that they are doing. So the way I'm looking at it is that the productivity improvements, what they are, getting in Domino's or likely to get in Domino's, will get reinvested for building many of these brands with a future growth point of view. So if you ask you, okay, just to put it this way, am I expecting margins to decline in the next couple of years because of front-ended brand investments in many of these? The answer is no.
And tell me, what metric are you looking to value the company, and how does the valuation?
Okay. Yeah. So most of the consumption stocks, not just Jubilant, we value on DCF. And the reason being that, most of these are, realistically long-term growth stories. And, many of these companies does have a track record. So these are really not quote unquote startups, right? I mean, so that context, and also there are benchmarks available. So for example, you broadly have a strong view on what is the appropriate cost of capital. You have a strong view on, beyond the next couple of years, how does the, let's say, if 10 years period, how does that growth should stack up? We also have a view on what should be the terminal growth, right? So I think, there is a certain, construct thought process which leads us to believe that the DCF is the appropriate valuation methodology for the India consumer stocks which I cover, and not just Jubilant. Having said that, I want to leave a number here, so that it's easier for someone else to actually evaluate. So the current stock price of Jubilant, is essentially implying around 17-18% sort of EBITDA CAGR over the next 10 years, and the terminal growth of 6%, which we believe
Growth of
is not at
6%.
all aggressive for a company.
17,
17-18% sort of,
6%.
let's say, cash flow growth.
You're
Yeah,
looking at
we
a
do take
terminal growth of
6% for
6%.
some of the high. That's correct. Which is what we take for most of the high growth businesses. And then obviously it tails off. Something at 5, something at 4. Maybe let's say tobacco business possibly could be the lowest.
Is this borne out internationally that food companies are able to sustain pizza? I would say. I mean, I don't know how the character of this company is going to change going forward. But can they sustain a terminal growth of 6%? Is that a good assumption to make, given the risks associated? I mean, now people are, the trend is towards more healthier food and stuff like that.
No. Okay. Got your question. See, first of all, when you say terminal growth, this is the growth of the company. This is not necessarily growth of one brand or one segment, in the real long term. So that's point number one to understand, right? So the second aspect is that, as I said, we do an explicit period forecast of 10 years, and then we say that 6% terminal. Now,
Right.
just imagine this, right? We are a $2,000 per capita country. Now, realistically speaking, our country should be a faster growth from a consumption point of view, not just for 20, probably for the next 50 years, right? We are probably what the US was like 60, 70 years back, right? From a growth point of view. So I understand that, if I'm actually making an explicit period of 50 years, obviously my terminal growth will come down significantly to a 2%. So what we do is that, I can mathematically do that. I can actually make a 50-year forecast. But do I really know that, how those numbers would actually, pan out post, let's the next decade, 30 to 40 or 40 to 50 or 50 to 60? Realistically, we don't have answers for that level of long term. So what we do is, realistically, you say, okay, this is a 10-year explicit, which kind of your mind can kind of, get some number to in terms of translating trends into numbers. Then you know that it's a high growth number. So then you say 6% terminal. So that's what largely kind of for the reason for a higher terminal growth.
I think that is it. Thank you, Manoj. And thank you. Greatly insightful to listen to this investment case. Thank you so much.